The share price, a figure that flashes on millions of screens every day. But what is actually behind it? Why does an Apple share cost over $150 today, and a Lufthansa share perhaps only $7? What drives these prices up or down? And how can you, as an investor, recognize whether a share price is fair, overpriced, or even undervalued? By the end of this video, you will be able to not only observe share prices, but really understand them. Let's get started right away. The share price is the current price at which a share is traded on the stock exchange. It therefore shows how much money a buyer is prepared to pay and what a seller will accept. Sounds simple, but the share price is not the value of a company, but only a temporary result of supply and demand. Example, if many people want to buy a share because they believe in the company, the share price rises. If, on the other hand, more people sell, the price falls. The share price is therefore not fixed, but a constantly fluctuating market price, influenced by expectations, emotions, news, and fundamental data. The auction principle applies on the stock exchange, similar to eBay. Buyers specify so-called bid prices, bids. I will buy 10 shares at 100 euros. Sellers offer ask prices, asks. I will sell at 102 euros. If a trade is concluded, for example, a buyer accepts the selling price, then a new price is created. The last price paid is the current share price. This happens every second, sometimes several times a second, especially with heavily traded shares such as Amazon, Tesla, or Nvidia. The share price is therefore a compromise point between supply and demand, constantly renegotiated by millions of market participants worldwide. This is where it gets exciting, because it shows how much psychology, economics, and speculation are involved. A few of the most important influencing factors are company figures, i.e., turnover, profit, or cash flow, as rising profits lead to confidence and, in turn, to rising share prices. The dividend policy. Does the company pay regular, attractive dividends? If so, it can attract investors, which increases demand, which in turn increases the share price. The economic development, i.e., interest rates, inflation, or GDP. When interest rates rise, for example, the attractiveness of shares often decreases. News and scandals, CEO resignations, data protection problems, or legal proceedings may reduce confidence, which also causes the share price to fall. Industry developments, for example, demand for AI, green energy, e-mobility, moods and trends. Sometimes people act irrationally, out of fear or greed. One example, between 2020 and 2021, Tesla's share price exploded, even though the company made hardly any fundamental profits. Why was this? Future expectations, hype, Elon Musk. In short, expectations drove the share price. The share price is therefore a reflection of reality, but also of fantasy. A look at the past shows. Share prices fluctuate, sometimes wildly. 1929 saw the stock market crash in the USA. The Dow Jones lost over 80% in just a few days, triggered by overvaluation, speculation, and panic selling. The dot-com bubble then occurred in 2000. Technology shares were in high demand, sometimes without a business model. When it became clear that many companies were not making any money at all, the bubble burst. The financial crisis in 2008, banks wobbled, Lehman Brothers went bankrupt, global crash. Share prices fell massively, and most recently in 2020, the coronavirus pandemic. A slump in March, followed by a massive recovery thanks to central banks and the technology boom. Conclusion: share prices not only reflect economic reality, but also fear, hope, and psychology. And they are never stable. A share price alone says nothing. What matters is what you get for it. That's why there are valuation ratios like the PE ratio, price-earnings ratio. This is calculated by dividing the share price by the earnings per share. An example, a share costs 100 euros, the profit is 10 euros, so the P/E ratio must be 10. A rule of thumb, if the P/E ratio is between 10 and 20, it is considered healthy. The P/E ratio, price-sales ratio, particularly interesting for growth companies that are not yet making a profit. Book value, what would the company be worth if all assets were sold? Some value investors compare the share price with the book value, price-to-book ratio. The PEG ratio combines the P/E ratio with the expected earnings growth, which is helpful for fast-growing companies. But be careful, valuation is no guarantee for price movements. The market can be overvalued or undervalued for a long time. A famous quote from Warren Buffett says, "In the short run, the market is a voting machine. In the long run, it is a weighing machine." In other words, emotions rule in the short term. Substance counts in the long term. Sudden price movements often happen because of quarterly figures that are better or worse than expected, analyst ratings, for example, buy or sell, takeovers, mergers, political decisions, new products or recalls. Example, if Apple announces that the new iPhone is selling worse than expected, the share price plummets. If a pharmaceutical company announces positive results for a new drug, the share price shoots up. Remember, it's not just about the facts, but above all about whether they are better or worse than expected. Volatility describes the range of fluctuation of a share price. High volatility means strong price fluctuations and therefore a higher risk, but also more opportunities. Low volatility means that the share price tends to remain stable. Here is an example. A startup from the biotech sector has extreme fluctuations because there are many expectations involved. A utility company like RWE fluctuates less, but also less explosively. Tip for investors: know your risk tolerance. If you don't sleep well at night when the share price falls by 10%, you shouldn't invest everything in volatile tech stocks. The share price is more than just a number. It is the pulse of the economy, the mirror of expectations and emotions. Now, I'm interested in your opinion. What was the craziest share price movement you've ever experienced? Or which share do you think is currently overvalued? Write it in the comments. And if you liked the video, then don't forget to like it, subscribe to the channel and activate the bell for more knowledge about the economy, stock market and finance. See you in the next video. Until then, stay informed and invested.